Paul, I have a recent article that says Home Depot is planning on buying HD Supply Holdings for $8 billion.
Is it $8 billion on the nose?
Well, New York Post is saying...
$8.7 billion.
New York Post is saying, yeah, somewhere in that range.
Well, the funny part is, I didn't even think they were separate companies. I thought they were the exact same company already. So when Don said this, and then he said, well, I think they're publicly traded, and they actually are, which was kind of surprising to me. But yeah, isn't that funny how that all works out?
Yeah, so how do acquisitions like this occur? What happens? And
well, what did the article say? Are they buying them in cash and stock? What's the deal?
let me read it to you real quick. The hardware store chain said it will pay $56 per share in cash for HD Supply.
Oh, wow.
Which sells construction materials, appliances, cleaning supplies, yada, yada, yada. Home Depot contends that the tie-up will help expand its footprint in the $55 billion marketplace for maintenance, repair, operations, and MRO productions.
What's MRO productions?
That's what it said, or MRO. Oh, that's maintenance, repair, and operations.
Oh, gotcha.
The deal is expected to close in the fourth quarter, which ends January 31. HD.
When was this announced?
This article is just from a couple days ago, 1 day ago, yesterday.
Oh, excellent.
HD Supply's stock price soared more than 24% on the news.
Yep, it went from 44 to like $55.
So do you want to let's look at both companies using our 8 pillars of stock
Let's look at
analysis?
HD Supply first, because we want to see how did Home Depot view this acquisition, right?
Yeah, what were they thinking? That's a great idea, Paul.
Okay, so what we're going to do first is, now remember,
Go ahead.
these numbers right here are up from when they made the, well, no, actually, I'm sorry, they're not, because they're $56 a share, so these are accurate numbers. So Home Depot basically said they're willing to pay 22 times earnings for this company. Now, why would they pay 22 times earnings? One of the things they're probably going to do is they're probably going to have some sort of cost savings along the way. And I'm sure if you delve deeper into it, they're probably assuming, okay, maybe there's $150 million a year we can cut from HD Supply's expenses that we're going to be able to absorb. And that drives then the number down here, because in the last year they made $400 million, and they can drive that up by 40%. It takes their PE down to 15 in some reasonable number. So this actually is so far from the first analysis of PE, doesn't seem like a ridiculous acquisition price. Okay, so it's kind of like, hey, they are paying me a nice premium, but I guarantee Home Depot has some sort of cost savings involved that they're probably estimating in there about how they can go sit there and drive more money to the bottom line.
So the market cap is $9 billion, but they're buying it for $8 billion. Is that a weird starting point, Paul?
Yeah, that's kind of odd, because if they're buying it for $8 billion, if you look at their ticker price, it's $55.78, and they're buying it for $56 a share, right?
Yeah, that's right.
So it's actually not $8.7 billion then. It's actually a little over $9 billion. But either way, potato. We won't worry about that right now.
So the PE you're okay with?
I'm okay, even though it's an X. I'm okay with it if they have cost savings in there, which, by the way, I'm sure if you read Home Depot's reasoning for this, there are cost savings in there. Do you understand what I'm saying?
Yeah, what about a dividend for this company?
There is no dividend. They're not paying any dividend.
Nothing at all, okay.
Their profit margin's in X as well. It's about 8.4%. I'm actually surprised by this, though. It's a good gross margin. So every single dollar they sell, they add about 38 cents to the bottom line. That's actually pretty good, because I don't think Home Depot is even that high. I'd have to check on that one. Maybe I'm wrong, but I don't think Home Depot is that high. So far, 2 X's, but again, in an acquisition, it's kind of like if we bought a piece of real estate. If we bought a new piece of real estate, we would have the management team in place. We'd be able to add 500 units without us adding any extra. And if we're acquiring staff, we could be like, hey, we're getting rid of some staff to save money.
Okay. Do you want to look at pillar number 3, which is revenue growth over the past 5 years?
Absolutely. So we'll look at the revenue growth. This is interesting. I'm not going to look just at the last 5 years, but let's start with the last 5 years. Why did I do that? I probably did it. 4.8, 5.1, 6, 6.1. Definite check mark there. But look at the previous 5 years. And in fact, in 2009, they did $9 billion in revenue. So everybody remembers 2008 and 2009 was the end of that's probably why they went public. It was the end of the whole real estate market. They were probably selling like crazy to flippers and things like that. So it's still a check mark here. But if you go back to 2011, they're still down in revenue. But they're starting to get back up again. They went down to 4.6, and they're starting to grow back up again, right?
How about profit growth? Pillar number 4 is profit growth.
So pillar number 4, we're just going to scroll down a little bit over here. We have $1.4 billion in profit in 2014, 15, whatever, 2016. That's garbage. There's probably something in here that's like some big major profit they got from something. So let's just focus on the last 4 years. 196, 970, 394, 452. It's technically a check, but again, it's very inconsistent profit. I don't really like that very much. It's very inconsistent profit. Guys, look at this. Look at their 2011 and 2015.
Yikes.
Loss of 600, loss of 500, loss of 1.1 billion, loss of 200, making 3 billion, 3 million. So that's a very weird, that's a very, very weird number. So technically it's a check, but I don't really like it very much.
How about pillar number 5 is number of shares outstanding. We want this going down, Paul.
197, 199, 192, 181, 166. Check mark there, kids.
Okay, how about current assets over current liabilities is pillar number 6.
Okay, we're gonna go to the current quarter, the most recent quarter, and the current assets are 1.7 billion, and the current liabilities are 920 million. So a definite check mark there, folks. We definitely have plenty of money left over there, about $800 million left over, so a definite check mark there.
Do you want to move on to free cash flow?
I would love to. Nothing makes me happier.
This is pillar number 7, free cash flow growth.
This is what I'm gonna look at the most.
Go ahead, Paul.
When it comes to this acquisition, because of their inconsistent profit. You saw that, right?
Yeah.
It was very up and down. But look at their cash flow over the last 5 years. So remember, free cash flow is cash from operations less capital expenditures. Now, you're not subtracting a negative. You're basically just adding these together. So here, it's about 340, and then about 430, and then about 410, and then about 470, and 570. Check mark there. Very stable free cash flow. So when we looked at their profit numbers, if you remember their profit numbers were very inconsistent. They're all over the board.
Yes.
But look at their free cash flow. Their free cash flow, did you add these all up yet, Seth?
Yeah, the average is 445.
So 445 times 20.
8,880. Or 8.8 billion, right?
8.8 billion. Look at that.
Right on.
So
right
they're
on
paying 20 times free cash flow. But I will say this. They're going to get some savings probably along the way. They're probably going to be able to save some money along the way and increase sales being combined with the Home Depot. So I bet you, I actually think this is a pretty good idea. And I usually am very against acquisitions. I usually think the companies are trying to just make it seem like they're doing better and bigger and better things by doing acquisitions. But this actually doesn't look very bad. So right here, we're looking at it going, it's a check mark here as well, pretty much. When you bought, if you'd owned this before, you'd been a check mark. Bottom line is, I'm not going to go back and forth on this one.
Wait, before you erase that, oh, sorry, Paul.
Sorry.
So what you just did is we did the price to free cash flow. So we found the free cash flow average, then we multiplied by 20 to get the price, and it was right on point.
It was pretty much exactly what they're paying for the company. So I look at that saying, with Home Depot, now, if you bought HD Supply before, if you had it before, by the way, at $44 a share, it was about a $6 billion company. You would have done well, and it had been a check mark still on the price of free cash flow. Now, as Home Depot's buying them, they're sitting there determining, hey, we're going to pay 20 times their average the last 5 years, but it's only like 16 times their previous year. And they think the future looks better for Home Depot and for HD Supply than it is today, then they're buying it at a good price with more growth and things like that. It's a good deployment of capital for them in their eyes, and they're using all cash. So what I want to do now is go to Home Depot's financials.
Exactly.
So let's pull up Home Depot's financials and see how this works out.
While Paul's looking at that, make sure you smash the like button. As always, we bring you this high quality information about stock analysis. This is all Paul in his mind. I'm just here to guide the ship in the right direction. But thankfully, you don't have to pay a nickel for this. You just smash that like and subscribe, and YouTube will pay us for it. We appreciate it. And as always, stay tuned for our Patreon, which is coming out very, very soon. Don, or looking at our producer, Don. And the Patreon will be coming out soon for more exclusive access to Paul and I, including my favorite Paul, the uncensored Paul and Seth show, where we get into it with some of our fans, and we don't talk like this with the rules of YouTube. We can talk more like real people and discuss. So you'll have access to Paul's portfolio.
The F word will be used a lot.
Yes, basically that's it. It's just like the F. It's basically it, Paul. Yeah.
It's free reign on the F word.
You get exclusive access to Paul and I cursing at each other. Paul, let's look at Home Depot stock. What is the market cap for Home Depot? So
Home Depot is $290 billion. So that means if you want to buy the entire company, don't worry about the share price. It's what you would have to pay to buy every single share outstanding. $290 billion. So
they're a lot bigger than HD Supply.
A lot bigger.
What about the PE? Let's talk
PE,
about
25. X. So this is definitely more expensive. Now this isn't, none of these pillars in and of themselves tell you what you need to know. It's about looking at them all together and deciding, what am I going to do with this? What further information do I need to pull from research and things like that? So right now we're starting with the X though on basically a 25 PE.
So right off the bat, Paul, does that PE sort of scare you? I know in the past for our viewers, we want the PE less than 20. We've seen PEs for some companies hundreds,
or not even existing because they don't make money.
Yeah. So right off the bat, is this sort of in terms of our first pillar? What does this tell you?
So with such a big company like Home Depot, it's kind of I don't know if I care that much about it right now. It's more about what is this? I need to figure out more. I'm not sitting there saying no off the bat. Like if this was 80 and I knew for a fact it was really 80 and it wasn't because of some big write-off, I'd be like, we're done here. Let's not even waste our time. If I'm not seeing revenue growth, et cetera. But right here, I'm like, okay, it's a solid X. I'm not saying yes, I'm not saying no. Just let's go find out more information.
Let's go to pillar number 2, which is profit margin over the past 5 years. Profit margin.
No, just profit margin currently.
Oh, I'm sorry. Sorry, Paul.
11%. So 11%. Check mark there. And remember, Home Depot HD Supply was at 38% gross margin. This one's 34%. So they're buying a company with a higher gross margin than we currently have. That's a pretty good thing.
Okay.
So we have an X and a check so far right now, right?
Pillar number 3 is revenue growth. I'm sorry. Yeah, revenue growth. Pillar number 3.
Okay, so let's go to their revenue for the last 5 years. Okay. 88.5, 94.5, 101, 108, 110. Check mark there.
It's good stuff there. How about profit growth? Pillar number 4 is profit growth.
Pillar number 4. So we're gonna scroll down here to net income. 7, 7.9, 8.6, 11.1, 11.24. Very consistent. And go back to the previous 5 years, 3.3, 3.9, 4.5, 5.4. I mean, this has been growing every single year for the last 10 years. Their profit's been going up.
Do you shop at Home Depot?
I do.
I love it there.
I prefer Lowe's.
You do? I'm the exact opposite.
See, I think Lowe's has better selection. And I think they have better customer service.
Wow, really? I
do.
I haven't even given them a shot. I actually... with many projects that I'm in, I like memorizing my store and just picking a spot. So
Plus, Home Depot's closer to your house than Lowe's. Lowe's, you got to go all the way to the Taco Bell, take a left.
And you love Taco Bell.
You got to do a little stop at the Taco Bell. I'll take a chili cheese burrito, please.
Is this profit, Paul, or is this just a revenue?
This is profit.
Okay, let's go to
pillar. So another check mark on the profit.
Pillar number 5 is the number of shares we want outstanding. We want that to be decreasing, the number of shares.
Pretty much every company in the world right now has decreasing shares outstanding. 1.28, 1.23, 1.18, 1.14, 1.09.
Why do you say that, Paul? Every company has
because they're taking their excess cash, and since it's hard to deploy capital, and they're just buying their dividends, buying their shares back. That's pretty much what everybody's doing.
And why do they do that again? Why do they want to buy their own company back?
Well, so one of the things that we do here, if I want to go to the main page here, Home Depot is paying a dividend, I believe, right? So 2.15% dividend. So in their eyes also, if they're able to hold cash and get paid 0.5% or 0, if they're buying their own shares back, they're saving that dividend. So they're basically also not having to pay a 2%. So it's basically giving themselves a 2% return on their cash. So in their eyes, they're providing a benefit to their investors by saying, hey, we're going to buy shares back so you own more of our company. And 2, we don't have to pay this dividend out to people anymore. So in their head, they're saving that, they're basically getting a 2% return on their money. That is not something I've talked about before, but I'm glad we're talking about it now because it is in their thought process. Now, with how expensive their stock is, I don't like them buying their shares back because to me, they're investing a lot of money back into their own company at a high premium. You want them to buy their shares back when the stock is cheap because they're taking their current cash and buying a cheap, inexpensive asset with it.
I'm trying to follow along.
I gotcha.
Paul. This is one of our tough,
Let me ask you this question, Seth. This is a great point to bring up. Let's say your house is worth $100,000.
Okay, let's do that. That's great.
Let's say your house is worth $100,000. Actually, you know what? No. Let's say you have a wallet. Pull your wallet out.
My wallet's in my car, but it's from 1994, Paul.
I remember this. It's older than you and I knowing each other.
Yes.
Let's say you have a wallet with $100 in it. But the market for some reason says it's worth $200.
Great.
Do you want to buy more shares of it or less shares of it?
Less shares in my wallet?
Yeah, let's say your wallet's a publicly traded company.
Oh, boy.
Okay, let's look at the house. Let's go back to the house.
Sorry.
Let's say your house is really worth $100,000.
Okay, got it.
But for some reason, the market says it's worth $200 right now.
Right now.
And it says, would you want to buy more shares of your house or less shares of your house?
No, I don't want to buy more shares.
Correct. You want to buy less shares of your house because it's overpriced.
Yes.
But let's say the house is selling. Let's say it's worth $100, but for some weird reason, it's selling for $50,000 right now. Would you want to buy more shares?
Go out and buy more house. Yeah, more. Yeah.
Same thing here. They're basically saying, hey, we're overpriced. We're going to go buy more shares.
Oh, no, that's not good.
We don't want that.
Okay.
Now, this is purely, in my opinion, a play on the dividend. They're sitting there saying, listen, we're going to get a 0.5% return on our money by putting our money in stocks, putting our money in our what's it called? Into low, like 90-day treasuries, something like that. So we might as well just buy ourselves dividend. We're saving our dividend back.
Now, by saving that money, does that increase the dividend they pay out to everyone else?
Nope.
No.
Keeps it exactly the same.
Okay, I got it. How about pillar number 6, Paul? How about current assets greater than current liabilities? What do you think?
I would love to look at that. So current assets here, $31.36 billion, as you can tell, right? And then current liabilities, 24.2. So definitely a check mark there. Let's scroll down a little bit more so people can see it.
Total current?
Total current. So it's a check mark there. It's 37, I think, versus 24. So definite check mark there, okay? That's a very, very good thing. They have plenty of cash on hand. Now, I'm sure a lot of it is inventory. We won't get into that really, but one of the things you'll want to look at is how much of it's inventory. 13 billion's inventory. Now, whenever a company goes, I want to just dabble into this.
Go ahead.
You never hold the inventory at exact the cost of inventory. So you want to mark that down a little bit in case there is an act of, let's liquidate the company. Inventory is not going to go for the exact same amount of money. But Home Depot holds major brands. They have a lot of good inventory out there. So I'm sure the discount on the inventory would not be huge, maybe 20%. So even with that, there are plenty of cash on hand to run to cover all their current liabilities. So
how about pillar number 7, your favorite, free cash flow growth?
Free cash flow growth. So guys, everybody remember, free cash flow is cash from operations net the capital expenditures.
Minus capital expenditures, yes.
So 7.8. Seth, you have your numbers out?
Yeah, go ahead.
8.1. 10.1.
Wow, that's good.
10.6.
They're doing great.
And 11.1. Check mark there. What's the average?
The average is 47 divided by 5, Paul, is 9.4.
Yep.
9.4.
Okay, 9.4. Times 20 equals 188
That's
billion.
Correct. That's correct.
It's currently selling for 290 billion.
Wait a minute now. What does this mean?
So that means do not buy. So
overpriced.
Yes. Now this is a prime example of when you looked at the 24 times earnings versus this is definitely saying, hey, listen, I get it. Home Depot is awesome. It's a great company. It's huge. But I think the assumptions that need to be made in order to make this happen are going to be very difficult. Now, they spent about 9 months of their free cash flow on the acquisition. So they could definitely afford the acquisition of Home Depot Supply, HD Supply. And I just think that this is a company that, as time goes on and you see the stock fall, you'll want to start picking up shares. Now, I do think, because of how big this company is, you'll want to start buying this company. I mean, look at this. Look at the history. It was selling for $152 back in March. And even before the collapse, it was only at $240. I'm looking at this company and thinking to myself, I want to buy it around $200 or less. That's when I want to start buying it. And the other thing is, $200 or less, look at this dividend. If it falls to $200, guys, this dividend will go up to 3%. That'll be about 3% dividend. So you'll be getting a good dividend. You'll be buying a good company with good growing free cash flow, and it's a worldwide brand. Like, we have our houses in Mexico. There's a Home Depot in Mexico in our town. Yep. There's no Lowe's, but there's a Home Depot in Mexico in our town. So this is a great company. Keep it on your radar. I like everything about it except for where it's currently selling. But again, at some point, now we didn't look at the technicals here. We should look at the technicals here. So we're trying to focus on the 100 versus 300-day moving average. And we're going to go to 3-year chart. And I want to go.
Make sure you're smashing that like button as always. Just reach down right now and give it a little tickle. There you go, Paul.
So back in May of 2019, it crossed over. The 100-day is in blue and the 300-day is in yellow. We want when the 100-day goes over the 300-day, it's a positive sign. When we back tested this strategy over the last 20 years and over 75 stocks, you beat the market by almost 1% by just buying based on these technicals. If you'd have bought it, you'd have bought it at 187 and it's currently at 280. You'd be riding this thing up right now. Now, look at this. It's also pulling away a little bit from the 300-day moving average, so it has some positive momentum. I think this is a very positive sign for the company. I wouldn't be buying it now based on technicals. You want to wait for this 100-day to cross over the 300-day, and when it goes back below, you exit the position. That's basically the idea. If you buy when the 100-day goes over the 300-day and exit when it crosses back under, and you're out, you'll beat the market. And do this in a tax-free account, like your Roth IRA or 401k, because there's going to have a lot of tax implications. You're not going to do a lot of trades. That's why you have to be watching hundreds of stocks. Mm-hmm. That way you can buy and sell as they come in. And the other thing is you beat by about 1%, and that's assuming that you only follow a set group of stocks. You're not even fully invested at all times. So it's actually less risk with beating the market. You're not even fully invested the entire time. So this is something that I'm getting into. I'm starting to like a lot, is using my cash, my excess cash, to start trading this way. That way I'm just sitting there like getting my money invested and beating the market and beating the 0.5% or 1% I'm getting.
Thanks for the analysis, Paul.
No problem.
That was incredible. If you've made it this far, you've obviously can realize Paul knows what he's talking about. So stick with us for more knowledge about investing.
Hit the like button.
Stock analysis, and hit the like. Thanks for following us on the Everything Money channel. Love you guys.